So, great to see everybody. Now, first of all, today is a two-part series. It's actually a three-part series. Part one is going to be strictly education. We're just going to stick to PowerPoint in a very structured lesson for the first hour. Then I think there's an hour break or something else in between, and then we're going to come back a little bit later, and we're going to start to apply this stuff. First by applying it to short-term trading, and then we'll do another session, I think it's next week, applying what we're going to learn today on long-term trading. All right? So, but very quickly, this session is all about, all these sessions are all about you, but I just want to take just a few seconds to just say thank you to FX Street, and thank you to anybody who voted for me for those awards that FX Street handed out. FX Street is really moving mountains in the industry. Where would we be without the FX Streets out there? Just a great platform for education and portal for everybody. But again, thanks again. And with the with the whole concept and everything that I do, make no mistake about it. I'm simply the messenger. I didn't create supply and demand. Einstein doesn't own physics and all the other guys out there. But I'm just the messenger. And my main pitch is that, look, how you make money buying and selling anything out there is exactly what you need to be doing in the market. And that's what we're going to focus on today. If you're someone who can keep things simple, you have some discipline, and you can really just drown out all the noise out there that comes with today's information highway, especially in the world of trading and high-speed platforms and split-second news, if you can kind of just forget about all that stuff and go back to just how you make money buying and selling anything, I think you'll do okay. All right. Well, again, so thanks again. Appreciate it. And let's move on. So, again, today, the key part that I really want to make sure you get, now we're going to focus on complete strategy today, but the biggest component of that is the ability to time the market's turning points in advance with a very high degree of accuracy. Okay, so before you start thinking, well, that sounds like we're going to learn, try to pick tops and bottoms. We are going to try to pick tops and bottoms. Don't be afraid of that, and don't shy away from that, because people frown on that. I mean, when you buy and sell things in other parts of your life, are you always trying to buy low and sell high? Why should it be any different here? The people that make the money, if you're losing money, okay, if you're in this session today and you're actually, and you're losing money, believe me, the people that are taking your money are buying low and selling high, and you're on the other side of those trades. So let's learn how to get on the right side of that equation today. All right? Now, and again, I want to start, just switch the slide here. So did you see me switch the slide, or do I have to capture that screen again, just so I know? Are you looking at a different slide now? And if you just tell me one time, I won't have to ask you. Okay, so you saw, you're not looking at a new slide. Okay, so I'll capture, every time I switch the slide, I'll capture it, then I guess I can do that. There you go, there's the next slide. Thanks for that. So the only point of showing you this, this is from today, made about $1,000 this morning in a very short-term trade in the Aussie dollar, Aussie US. And I just want to let you know that if you really pay attention to what we're going to go over here today, both in the lesson and then trading application a little bit later on, my goal is to make sure that you walk away from these sessions having a very solid understanding of how to do this. Okay, this is all real money trading that I'm showing you. These aren't demo accounts or hypothetical returns. This was just little short-term trading off a little 2- and 5-minute Aussie dollar chart. I'd say about 2-3 hours ago. All right. So I want to make sure that you understand that. The goal here is that you can walk away from this stuff having a very solid understanding of how to do just this. All right, let's move on. Okay, I'll capture the chart again. Now, that trade was taken in the Aussie futures. Okay, most of the trade examples here that you're going to see are taken in the currency futures. So that was global futures, Mike. Okay, that was global futures platform. All right. Short-term trading, everything I do in the forex market is in the futures. But it doesn't matter if you don't trade futures. It doesn't matter. It's the same market, same chart. Okay, it's not like one It's not like the futures are moving up and the forex is moving down. It's the same market. All right, so take a look. You can see the next screen here. And again, in order for you to really grasp the concept and get the strategy, here's a big problem in the world of trading education. People are presented with a chart and a pattern and told, okay, this pattern works 80% of the time. Let's memorize the pattern. Now go trade. Okay. The problem is everybody skips the most important part with that. It's understanding the logic behind it. Because if you thought the logic behind just about every conventional technical analysis pattern or setup out there, you wouldn't even care about the pattern because you'd realize it doesn't work. It can't work. It's flawed. So let's spend a few minutes getting your mind in the right spot. Let's get your mind in the right place to be able to absorb the strategy and information properly. And at the same time, we're going to be learning all the way. So really ask yourself, let's focus on the picture on the left. You know, how many people, there's a chart on the left, and we've got some indicators, some oscillators, okay? Yeah, SW, we're going to, by the way, anybody that's been through one of my education sessions here, today we're taking things a lot deeper. I mean, this is a full-blown 3-part series, so we're going to cover things we've never covered before, all right, including profit targets, okay? And we'll go over that Aussie trade as well, SW. So take a look at the chart on the left. A lot of people probably have, maybe people have charts that look like that, loaded with indicators and oscillators. There's some pivot points. There's so much stuff on the screen, you can barely see the candles, right? And I've also listed just a few of many conventional chart patterns, indicators, oscillators, news-type things on the bottom. And we could add a few hundred more to that list. But if you really look at that chart and look at some of the stuff below, and some of those items below the chart, have been in trading books, for the last, 100 years or so. But really be honest with yourself here and ask yourself, who really makes money? In other words, do you know anybody that makes a consistent living using that stuff that you see there on the left? Because this is the stuff that dominates the trading education world. This is the stuff that dominates the trading books. And but when you ask yourself, how many people do you know that make a consistent living using that stuff? There's probably not many. And for most of you, it's probably zero, right? Now I'm comfortable asking that question because I already know the answer. I've been in the trading world for long enough to understand how this stuff works. Now let's take a look on the right. How about that group? Do they make money? What about that group on the right there? How do they do when it comes to profits? They're probably one of the best out there, right? Okay, they do pretty well. In fact, they make more money, than most countries probably print, right? What's their big secret, right? What do they do? What's their big secret? They buy at wholesale prices and they sell at retail prices. They buy the plastic for 25 cents. They sell it to us for $1, and we are more than thrilled to pay for that. Have you ever been to a Walmart at 8 o'clock in the morning, noon, 4 o'clock in the afternoon, 8 o'clock at night, 10 o'clock at night, right? Is the parking lot ever not full? You ever go to a Walmart, at like 10 o'clock at night and try to get a good parking space? Okay? You understand what I'm saying? All right. So what we're going to do here, now, the main point here is, now it's not fun and not like, it doesn't sound great to say, hey, I want to be like Walmart, right? Because, most people don't, it's not the highest end, logo and tag out there, right? So it's not fun to talk like that. But trust me, in the trading world, you want to be Walmart. I am proud to say that I try to do exactly what Walmart does in the trading world. I am proud to want to be like Walmart when it comes to trading, all right? And that's all we're going to learn how to do, okay? So you have to think in those terms, and you have to really just kind of forget about all that stuff on the left, just for a little bit, right? So to get this market timing concept to you, let me grab the next chart here. Again, for those who came in late, the first hour is all education. I'm going to shove this logic and strategy down your throat for the next hour. Then we're going to come back and do a trading session later on and start to apply these things, okay? Yeah, Nick, a lot of the time I do. So to get this market timing concept to you, and make sure you understand that we're going to focus on two key things here. Now, I run the trading rooms, the XLT program, we call it, an online trading academy, and I can tell you in the Forex XLT, the Forex trading room, we have lessons in there. Okay. Now, what I did here was I pulled part of that lesson out, and I want to share it with you here. Okay, to get this market timing concept across to you, to make sure that you can understand how to predict where the market's going to turn in advance with a very high degree of accuracy, we're going to focus on two key points here. Number one, where do prices turn? Now, why is that important? Well, again, the whole concept of market timing is important because if you want the ability to attain the low risk, high reward, and high probability entry points into any market, any time frame, you absolutely need to know where the market's going to turn before it turns. Okay? Now, you're not going to catch every turn in price, but the significant turns, we should be able to see those coming in advance with a very high degree of accuracy. Okay? So how does it all work? Well, if you've listened to anything I've said over the last couple of years, you understand that the movement of price in any and all markets is simply a function of this ongoing supply and demand equation. Okay? Which means opportunity exists when this simple and straightforward equation is out of balance, right? If you understand that, then you'll understand that the most significant turns in price, right, happen at price levels, again, where supply and demand is out of balance. So, the only question left is, what exactly does that picture look like on a price chart? Okay? That's the picture we need to learn how to identify. And we're going to do that in just a couple minutes, right? So where did I kind of get that? Where does this come from as far as me and my trading goes? Well, I started my career on the floor of the Chicago Mercantile Exchange, actually in the currencies, years ago, handling institutional order flow. That was my job in the beginning. All right, I would take orders from institutions, banks, money managers, hedge funds, you name it, even some retail traders. And my job would be to facilitate those orders, right? So what I would do is every day I'd get down to the floor. Now really hear me out with this, because as we get to the charts, the story I think is really going to help you, okay? Try to visualize this stuff. So I'd get down to the floor about an hour before the markets would get going, and I'd be answering those phones, taking those orders. And about 15 minutes, I'd say, before the markets would really get going, I'd stop answering the phones because I had this big unorganized mess of paper in front of me back then, right? No different than today. It's just today's everything's screen-based. Same thing, though. Today it's just better because the numbers are bigger. But anyway, so I'd stack those orders. I'd create piles of orders all according to price. Okay. So each stack of orders is the same price. I'd put the buy orders to my left, the sell orders over to my right, and off we would go. Okay. But make no mistake about it. If I wanted to know where the market was going to stop falling and begin to turn higher, all I'd have to do is look down into my left and find the largest stack of buy orders below current price. That was the market's real demand. If I wanted to look down, if I want to know where the market was going to stop rallying and begin to turn lower, all I have to do is look down to my right and find the largest stack of sell orders above current price. That was the market's real supply. Okay. SW, whose orders were they? These were orders from banks, institutions, money managers, hedge funds, right? That was one of the biggest trading desks at the time. Okay. Now, one thing that's very important for you to understand is you may be hearing this thinking, well, I know what he's talking about because I look at the matrix. I see all the bids and offers coming in and things like that. Well, I would argue that those things aren't real. Okay, how often is it that you see the bid much bigger than the offer, but prices fall, or the offer 10 times the size of the bid and prices rally, right? It's because those orders aren't real. The real intention of those orders is not for them to be filled. It's to disguise real intentions. Let's talk about the orders I was dealing with on the trading floor, right? First of all, one of the reasons why I know that they were real is because most of the time those orders didn't get pulled. They were there to stay. Okay, people didn't call up often and say, "Hey, pull that order." They were there to stick. But the biggest reasons why I knew that was real demand and real supply in the market is because I was not allowed to trade my own account. It was illegal, okay? You could not trade your own account. I had to sign papers saying I wouldn't trade my own account, and my family wouldn't, and all this stuff. Why? Because these were real buy and sell orders, okay? Second reason Okay. Not only could I not trade my own account, but there were like cameras pointed at you from every direction. Every phone call you made was recorded, and often there was a third party on the line listening to you. Why was the security so tight? Because those were real buy and sell orders. All right. So we're going to learn to see what that looks like on a price chart. We're going to identify exactly what those real willing buyers and sellers look like on a chart. Again, just a couple minutes. Number two, you need to start thinking about who is on the other side of your trade. It's such an important thing to do. Okay? A lot of people don't think about this or even consider it until you make them aware of it. But it's so important. Okay? So the goal here, okay, the goal here is to make sure that there is a novice trader on the other side of your trade. Okay? I mean, wouldn't it be nice, okay? Wouldn't it be nice if every time you push the button you knew that there was a consistent losing trader on the other side of your trades? Okay? That's the goal. Right? Let me just make sure I'm not missing any questions. And we'll probably, I'll try to get all these questions at the end. And most of your questions, just so you know, I don't want to discourage you from asking questions, but just understand that most of them will probably be answered during the presentation here. But let me skip back here for a second. Okay. Sure, they were there, usually until they got filled. Most of them were definitely there for the day. Okay. Trade daily, yeah, there was huge orders, and a lot of these are multi-million-dollar positions, right, at the time. All right. Okay, no problem. So number two, who's on the other side of your trade? Again, every time you push the button, there was someone on the other side of that transaction trying to take your money. Okay. Now, ideally, we want to make sure that we are trading with novice market speculators. All right. How do you know the difference? Now, let me ask you here: how many people? There's 148 people in here. How many people can really spot a novice trader on a chart? Okay, how many people can spot a novice trader on a chart? And you can answer that if you want to. I mean, looking at a chart, you can put your finger on it and say, that is a novice buyer or that is a novice seller. How many people can do that in our group here today? Haley's saying that they just look in the mirror. That was pretty funny. Thanks for that humor. Okay. That was good. All right, so as you can see, now I want you to look at the chat. Not many people said they can do it, right? So here's my next question. If you cannot spot the novice trader on a chart, who do you think that novice trader is? Okay, you get the point? So I would not put another dime of money at risk in the market, of your hard-earned money at risk in the market, until you know exactly what a novice trader looks like in the chart. Because if you can't spot that novice trader, it might just be you. Exactly like poker, Mike. If you sit down at the poker table and you can't identify quickly who's going to pay the table that night, it's probably you. All right? Anyway, so we're going to learn two things here. Number one, to identify those price levels on a chart where supply and demand is out of balance. And number two, exactly what that novice trader looks like on a chart. Let's do that now. Okay? And again, I'm starting out, some of you that have been with us for a while, this may be a review for you. But trust me, we're going to take this stuff along to things that we've never gone into before. We're going to do that during this session. We'll do it during the next session in a few hours here. And let's keep going. Okay? So now let's learn to identify those two things on a chart. And then we'll take it deeper adding these things called odds enhancers. Number one, where and why do market prices change direction? Let's learn to identify those supply and demand levels. So I'm pointing to the chart here. You should be able to see that. Let's focus on this area right here, okay? Here, prices are trading sideways. Supply and demand appears to be in balance, okay? Price isn't moving up or down that much. It's just moving sideways. But all of a sudden, there's a strong drop in price. Now, a lot of people will look at this drop in price and say, ooh, I can't wait to learn how to predict that that's going to happen. Or, I can't wait to learn how to get paid when this prices drop like this and make money in that. That's not what we do. We don't do either of those two things. Instead, we sit back nice and relaxed and we let prices drop away from that level. When they do, we understand that the only reason why prices drop away from this level as they do is because supply and demand are very much out of balance at the origin of that drop. Okay? In other words, again, the only reason why prices drop as they do here is because there's way too much supply up here, no demand, and anytime that equation happens, prices are going to fall. So think about the trade desk. We want to know where that big stack of sell orders is, right? I mean, if you know where the real buyers and sellers are in a market, can you lose money, right? You have to do something really foolish to lose, right? Okay. So this is that big stack of sell orders on the trade desk right here. What we're going to learn to do here, and we'll do this more in the second session, is we're going to learn to wrap two lines around this level based on a very specific set of rules. And we're going to carry this level forward, creating that sell zone or supply zone. We want to remember where the sellers are, all right? Down at the bottom, just the opposite is true. Prices are trading sideways. All of a sudden, there's a strong rally in price, okay? Again, once this rally happens and we let it happen, that's when we can say, aha, we now know where willing demand exceeds willing supply, where the real buyers are in this market, okay? So again, we learn to, we wrap two lines around this level, carry this level forward, creating that buy zone or demand zone. Now, how can I speak so strong about that level? How can I say, demand exceeds supply there with such confidence? Because think about it, if that statement was not true, okay, wouldn't prices just keep trading sideways here if there was equilibrium or balance, right? They would, but they didn't. They rallied away. Why? Because demand exceeds supply there, right? Let's see here. Baston, I see what you're saying. The stack borders might disappear. I wouldn't say that's something. The most important thing there is, there'll be people that say, that support level didn't hold, or that, prices blew through this level or that level. What happens is, what's your, I'm not talking about you, but, what's that person's definition of support and resistance? Because, my definition of support and resistance is going to be very different from someone else's, and that person's going to be very different from yours. So, prices go through areas all day, but for me, they go through areas that I would expect them to go through. I will tell you that, again, this is just my opinion, but one of the most dangerous things in the whole world of trading education is conventional support resistance stuff, okay? How all the trading books out there draw support resistance lines, to me, makes absolutely no sense. It forces traders to take, the short way to say it is it forces you to jump into losing trades, quick losing trades, if you really follow the rules of conventional technical analysis, okay? So, you should have sound. Everybody should have sound. Okay. Anyway, so what here is really defining what supply, demand, support, resistance is for us, okay? So far we've learned to identify supply and demand levels on the chart. Let's move to step number 2, and then we'll take this stuff a lot deeper. Step number 2, understanding who is on the other side of our trades, okay? All right. It could be, okay? Not always, but it could be. So let's deal with step number 2. Let's learn to identify that novice trader, that novice market speculator on a chart. The good news is they're very easy to identify because they always make two obvious mistakes. Now, why would they make these obvious mistakes? Because they don't know they're making them. If they did, they wouldn't do it, right? So let's take a look right here, okay, the area I'm pointing at. And let's specifically focus on the buyers, all right? Here, these buyers are those novice market speculators. How do we know? They're making those two mistakes. Mistake number 1 that these buyers are making, they're buying after a rally in price, okay? Not a smart thing to do to buy after a rally in price. You would never do that in any other part of your life and be consistently profitable doing it. Think of your favorite restaurant and think of your favorite meal that you order at that restaurant. No matter how good that food is, when the server comes and brings your check, whatever it is, do you ever offer to pay more? If it's $40, you ever offer to pay like $60 or $70 because you like the food so much? When you buy a house, do you ever offer more than the asking price? Of course not. You would never do those things. So why in the world, when people come to trading, do they do that here? Okay, that's exactly what they do. Not a smart thing to do. Okay. Yeah, we're going to cover. I'm looking at some of the questions there. I'll try to get to all of them, but I promise you, we're going to get to a lot of those questions are going to be answered during this session. Okay, but I'll definitely scroll back. All right. So anyway, mistake number 2. These buyers are buying right into a price level over here where we've already identified supply exceeds demand. Okay? So think about it. Someone buying after a rally in price and buying into a price level where supply exceeds demand, what are the chances that this buyer is going to make money in that trade? Right? Think of the basic laws of supply and demand. They're buying after a rally price into a price level where supply exceeds demand. The laws of supply and demand guarantee that they are going to lose consistently. Maybe not every time, but consistently. Okay? All right? So, instead of being that novice buyer, we want to be the seller. All right? Prices then fall, and down here, if we specifically focus on the sellers, again, it's that same group of traders, only here they're selling after a drop in price, mistake number 1. They're selling into a price level where demand exceeds supply, mistake number 2. Okay? Instead of being that novice seller who's selling because of these scary red candles or, the bad news, we want to be the buyer, specifically right here at this black line with a protective sell stop just below the area. Buying right here, according to our rules, okay, is the lowest risk, highest reward, and highest probability time to buy into this market. Okay? Now, if you've ever read the trading books, okay, the books say don't buy here. Okay, they all warn you against buying here. They say don't buy right here where I'm telling you to buy. They say, wait for confirmation. Wait for confirmation of a green candle, right? Don't buy here because you don't know that there's buyers left. Let the market show you that there's buyers here. Wait for a green candle. But if we wait for this green candle to form and then buy, what's now happened to our risk? Has it gone up or down? All right, what's happened to our risk? It's gone up. Yeah, what's happened to our reward or profit? In fact, our risk has almost doubled. Now, what's happened to our reward or profit margin? Yeah, exactly. That's gone down too. Or that's gone down, right? Yeah. So now, if you were to, how would those two things work for you in a business or in a company? Would you ever be successful in a company doing that? Of course not. All right. And what we're talking about here today, by the way, any time frame, any market, you apply it equally. All right. So what we've learned so far, and we're going to get to the charts in just a minute and take this deeper. We're going to identify supply and demand. We've learned to identify what the novice buyer and novice seller look like on a chart. Now, so in other words, we're selling short on the first retest, not the second, the first retest of a level, and we're buying on the first retest of a demand level. Okay? Because until prices move away from these areas, how do we know what the real supply and demand equation is there? You don't. You can guess, but why guess? The chart will tell you. The price action will tell you. So once the price moves away from these areas, we want to get in on the first pullback to these areas, but not just any areas. We're going to really define this as we go along this morning. All right. So let me just take a moment here to just kind of tell you, the consistently profitable trader, or I should say, like the average Wall Street firm, has it very easy, or the average, the good Forex dealer desk, what have you, they have it very, very, very easy. In fact, they're laughing all the way to the bank. Okay, they're laughing all the way to the bank. No, you absolutely don't risk 100% on the trade. Yeah, not every trade is going to work, Bastion, but once we get through the odds enhancers, you should be able to identify the key market turning points. We'll get into that in just a little bit. Okay, so again, the consistently profitable trader has it very, very easy. Again, laughing all the way to the bank. Think of it this way. Compare the average trader or investor's returns around the world to the average, say, Wall Street firm's returns. Okay? To the average Wall Street firm's returns. We'd probably all agree that it's a pretty lopsided equation, right? Right? One group's making all the money, the other group's barely making anything. Okay? Have you also ever noticed that, what would you say? What's the percentage of people that lose money trading? I really don't know what it is. I don't think anybody knows exactly. Is it 80, 90% of people that try this lose money? 95%, Mike is saying, right? Okay? But what about that other 5 to 10%? Are they just making a living, or are they making a killing? What would you say? Right? Are they just making a living, or are they doing pretty well? Yeah, they're making a lot of money. So do you ever wonder why that is? Why is it that the majority of people get this wrong, but the very few that get it right make a fortune? Okay? It's because of this. Now think of that average trader that we just, well, let me ask you this. What does that average trader or investor around the world do that we agree doesn't do very well? What do? They buy stocks, right? I'm talking about the average person buy stocks, right? Now, what is Wall Street's primary business? What is a Wall Street firm's primary business? What's their primary business? Selling stock, exactly. Right? So one group's buying stock, the other group's selling stock, and the sellers are making all the money. Okay? Now, I'm not at all suggesting that we should stop buying stocks and start selling stocks. What I'm strongly suggesting, we're going to get into now, is that you need to start thinking like that second group, because they are laughing all the way to the bank. It's so easy for them, and here's why it's easy. Okay? What does that average trader or investor do? And I'm talking about you, and I'm talking about me. What were we all trained to do from a very young age? Now, take yourself back to grade school, high school, university, grad school, and it gets even worse if you read the trading books. And I'm including myself in that. I remember how I was taught all this from an early age. What do we need to do before, let's say we buy a stock, for example, right? We have to make sure it's a good company with strong management, with a healthy balance sheet, right? What about earnings? They have to be really, really good earnings for the company, right? Okay. And what about the trend of the price of the stock? Does it need to be in an uptrend or a downtrend before we buy it? What about the trend of the price of the stock? Does it need to be in an uptrend or a downtrend before we? It's got to be in an uptrend. That's like the golden rule. Well, let me ask you something. Where do you think the price of the stock is when all those things are true? You think it's ever down here at demand levels? Of course not. It's always right here, okay? Everybody, including myself, is so conditioned to do this exactly opposite of what we should be doing. People aren't even aware of how strong that conditioning is, okay? Now, instead of calling this a supply level on the chart, instead of calling this a demand level, there's other words we can use that are even more appropriate. Demand is really what? Wholesale prices, okay? Instead of calling this supply, call it retail, okay? Buy it wholesale, sell it retail. The Wall Street firm, the successful, Forex bank or dealer desk, the consistently profitable trader is simply buying at wholesale prices, demand levels, and selling at retail levels, supply levels. What is the average person out there trained to do? And remember back when you were in school, and think about every trading book you've ever read, right? The average person is conditioned and trained to buy at retail levels and sell at wholesale levels, okay? Exactly, Haley. There's a guy that's got it right? Now, that guy didn't just make a living, okay? Does Warren Buffett do anything special? Let me ask you this. Does Warren Buffett do anything different than you do when you go to the grocery store or when you go to a Walmart? Does he do anything different than you do at those places? Or have you ever gone to the car dealership? What do? Right? At a car dealership, they tell you the price of the car, and you offer a lower price. Isn't that what Warren Buffett would do? What's his edge over everybody else? He's just smart enough to know that that's exactly how this works in the trading world, okay? And he knows that anyway, let's move on. I think I made my point, hopefully. All right. All right, we're going to look at tons of charts. We're going to go over odds and answers, but I just want to set this up with a trade took not that long ago. And again, I'm going to show you the trades we took today and last week and all that. And you're going to see the same picture over and over and over, okay? And the picture is simply just buying at wholesale prices, selling at retail prices. But for you, the goal is to learn how to identify these wholesale and retail prices. So here's a chart of the Swiss, little 5-minute chart. Okay, little 5-minute chart. Down here, identify this as a demand level. Why? Like we just learned, this is the origin of a pretty strong rally. Okay, prices are trading sideways here. Strong rally ensues after that. Now, I'm going to throw some questions at you, so please answer. I think it'll help you. We'll make this interactive. Why couldn't prices stay here, and why did they have to rally away? What's the only reason? And I don't mean to talk to you like you're in kindergarten. I just want to make sure that you get this, because it really isn't that complicated. All right, exactly. Demand exceeds supply. Next question. Notice when prices were in this little yellow shaded area, did price spend a lot of time there or just a little time? A lot of time or a little time here? And this is going to be a big point. Yeah, very little time there. Again, the reason is because supply and demand are so out of balance there, right? Okay? So, again, the more out of balance supply and demand is, the less time price is going to spend there. We're going to talk about that more in a few minutes. So the fact that price spent very little time here and then shot up away means that there's a ton of willing demand here. There's a lot of willing buy orders that did not get filled. Way too many. Okay? Oh, you guys aren't even looking at the chart, are you? Let me, sorry, I don't know if I clicked on the new chart. All right. You should get it now. There you go. Okay. Correct, Baston. But Baston, one of the things we do is we need to identify a fresh level. So we have a specific definition for a fresh level, and this meets that criteria. Okay. All right. So next, so given that price spent so little time here and it shot away from this level, telling us demand greatly exceeds supply here. That's step number one. Don't forget step number two. Let's come back over here. When I push the buy button here for this little trade in the Swiss, who was I buying from? Who was on the other side of that trade? Was it a consistently profitable trader or a novice trader? In other words, or keep it real simple. Ask yourself the two questions in the beginning. Were they selling after a drop in price? Mistake number one. Were they selling into a price level where demand exceeds supply? Mistake number two. If the answers to both of those questions are yes, and the risk here, again, we're entering the position at the top line with a stop below the bottom line, compared to the reward, which is the distance to the first target or the opposing supply level. If that risk-reward meets, the minimum criteria that you're looking for, you take the trade like a robot. Okay. Another way to say this is, and then we'll move on. I simply bought at wholesale prices from someone who's trained and conditioned to sell at wholesale prices. I simply sold at retail prices from someone who's trained and conditioned to buy at retail prices. Okay? Does everybody understand that? Okay. Am I doing anything different than Walmart does? I love being Walmart in trading. I love it. Okay? You want to be Walmart. We have to make like big T-shirts and say, "I'm proud to be a Walmart trader." No, I'm just kidding. Some of my examples and stories, I agree, are not that great. So if you think of any better ones for me, believe me, I'm open. Send me an email. Right. You exit this trade at once it reaches the opposing level question there. Okay? And we're gonna take this deeper. Okay? Yeah, you did sell at the level above, Mingus. That was where the profit was taken. Thompson, SD Thompson, I've seen you in here before. I want to make sure I get your question. So rally-based rally and drop-based rally, okay? Higher probability ones, first of all, you want to make sure that they're both fresh, and a lot of these things we're going to get to in the session here. Those rally-based rallies like that one you just saw there in the Swiss, they're fine as long as there's a significant profit margin with them, okay? But obviously, the drop-based rallies have you buying lower on the curve. Okay. Mickey, you can certainly set and forget. If it's a trade that's on a decent sized time frame, and you're putting your order to buy at a deep discount demand level, the seller there is probably going to be a novice seller, right? So you don't have to worry about that. Okay. Yes, profit margin, location on the curve is everything with your original question there, okay? We'll try to get to I don't know if we'll get to the curve in this session. We'll try to, but we've got plenty of time today and next week. All right? And remember, too, what I'm trying to give you here today in an hour or two is something that, we spend so much time on in the trading room and online trading academy. We've got a lot of FX Street members in that as well. We can talk about that later, though. Let's keep plugging away here. Let me grab the next chart for you. It's time just flies by, and never enough time. So, think back to our trading floor example, and which is not, it's a real example. It happened every day. But now we're looking at charts. Okay, 90% of the charts you're going to see are currency charts. This one happens to be the S&P, but it's the same concept. So now we're looking at charts. So, I could not trade my own account on the trading on the trade desk because it would have been free money. You couldn't lose, right? And that's because you have the orders. If you have the orders right in front of you, you know exactly where the significant buyers and sellers are. But when we come to a price chart, there's a big piece of the puzzle missing. In fact, the biggest piece, right? We don't see the orders, okay? What we see instead, and Bastien, I think you were mentioned this before, instead we see lots of support resistance levels, lots of supply and demand levels. So how do we know which ones that we should focus on and which ones we should ignore? This is going to be, if you don't know it yet, this is going to be your biggest question mark going forward. How do you know which levels you should focus on and which levels you should ignore? Okay, to do that, we're going to dive into these things called odds enhancers. I'm going to give you a few of them here, and we'll take it deeper as the day goes, as our session goes along today. All right. So the first one, in other words, the purpose of what we're going to go, this little exercise we're going to go through now, is to clearly teach you how to identify price levels where supply and demand is out of balance in a very big way, and more importantly, to teach you how to identify price levels where it may look like a supply or demand level or support resistance level, but you know what? There's not a big supply-demand balance here, so we want to ignore it. All right? So here we go. Number one, okay? First of all, on this chart, here is our supply level. Now, why do we call this a supply level? Because prices could not stay here and dropped away, okay? But number one, how did prices leave the level? This is our first odds enhancer we're going to talk about. So notice prices gapped away from the level here. Now, we don't see too many gaps in the Forex market, but we do on Sundays, right? And that's important. That's significant. So understand that prices can move away from this level in one of three ways. It can be a gradual move away from the level. It can be a stronger drop away from the level, maybe with big red candles. Or prices can gap away from the level. Out of those three choices, which one represents the strongest supply and demand imbalance? And just think your own logic through. Not a difficult question. Yeah, the gap. So the rule and logic here is the stronger the move in price away from the level, the more out of balance supply and demand is at the level. Make sense? Okay. I'll grab the chart for you again. I see a couple people. See it? Number two, how much time did price spend at the level? Now, we already talked about this for a few minutes, but let's do it again because it's important. Because this number two, when I talk to you about it, I'm actually giving it to you the opposite of how the textbooks give it to you, okay? Think of it this way. So all the conventional technical analysis books out there, when they talk about support resistance, they say look for price levels on a chart where price spent, if you want to find key support resistance levels, look for prices on a chart where you have lots of trading activity, many candles on a chart, where there's lots of volume, climactic volume, right? Look for areas like that. But if you think the logic through, I think you'll find that the opposite is true. Jack, yeah, we definitely go deeper, but we're certainly going to go over plenty today. Okay. So now, think the logic through. I think you'll find the opposite is true. Okay. And let me ask you this. At price levels in any market on the planet where supply and demand is most out of balance, are you going to get many transactions or very few transactions? Very few transactions, right, and that's because of the big imbalance. Now, at that same price level, you have the potential for the most activity, but the reason why you don't get it is because all that potential is on one side of the market, the buy side or sell side, right? Okay. So we all agreed that you get, few candles and not a lot of activity. So again, what's that picture going to look like on a chart? Is it many candles like the books say, or is it very few candles? It's going to be very few candles, right? Right? And what about volume? Is it going to be heavy volume or maybe lower than average volume? Right? It's probably going to be lower. Yeah. And again, both of those things are exactly opposite of what the books say, but don't take my word for it. Just think the logic through, okay? Bastin, no, not just a spike, because that if you just go with that, you're missing a big component. That what you're saying right there with the big wick, that might already be a pullback into a level, so we wouldn't want to take that second time. But we'll go, spikes are not the greatest. S.T. Thompson, very experienced there. Yeah, don't. But hear me out again. We're gonna go through this, and I think you'll get it. Okay. I just wanted to, get on that question for you because I don't want you just looking for those. Okay. All right, fresh levels, we'll get there too. Let's go with another one here. All right. Take a look at this chart. Let's add a third one. So again, before we right, but that spike, because of the pattern, is often going to be already a pullback into another level. Okay, but you'll get inside those spikes. Let's say you have an hourly spike that you're talking about. I'm sure inside that, on a 5-minute chart down at the turn, you're going to find a nice level that we're talking about. Okay, all right. Okay, so let's look at this next one. Let's go through it. But again, before we focus on the chart, let's make sure we all understand and agree on the logic. So let me ask you this. Let's say today you get to be on the trade desk and you get to trade your own account. It's going to be a free money day, and you're all excited. Let's say you come in and you're watching the euro, and let's say the biggest stack of sell orders above current price in the euro is at 137.50. Okay. That day, and you don't have any demand for quite a while, but that big stack of sell, you have a giant stack of sell orders, tons of supply at 137.50. Where are you going to feel comfortable selling short that day? 137.50, right? Okay. But let me ask you this: is there anything that would make you more comfortable selling short at 137.50? How about this? Let me ask you this. How about if there was an even bigger stack of sell orders at 137.55? Would you now be more comfortable selling short at 137.50? Would you be more comfortable if you had an even bigger level right behind it? Of course we would, right? Okay, so what does that picture look like on a price chart? It's levels on top of levels. And it's subtle, but almost every trade that I'll ever show, and you'll see this later in a couple hours or in an hour or so when we get into the live markets, most of the ones that I'm willing to put my money at risk on have this levels on top of levels concept. It means it's just a strong opportunity. Okay? So look at the chart. Here we have our first supply level up here, rally, base, drop. Now this becomes a supply level when you have this big red candle that falls away. Just below it, we have another supply level, very few candles and a gap. We like that, right? That's good. So given that we have two levels on top of each other, that look pretty strong. Again, the question is, when I push the sell button here, who was I selling to? Okay, was I selling to a consistently profitable trader, or was I selling to a novice trader who's buying after a rally in price and into that price level where supply exceeds demand? Okay, the news was good and there was a nice uptrend underway, but again, that's conventional thinking and conventional talk. The fact is, prices are at retail levels. And when prices are at retail levels, we want to be the seller. Okay, Adrian, yes. When price came back to here the first time, they were retracing into this was a fresh level. Remember, right here, if you're looking at this wick doesn't actually touch the level. So this was the first pullback into this area. All right. Now there's a couple ways we enter this levels on top of levels concept. All right. Okay. Again, these are all trades that I just took, either in the XLT or just in my own account. Let's take a look at another one. Let's add another odds enhancer. Hopefully these are helping, and hopefully you're starting to really get this. Okay, and again, we've got a second session coming up in a little while. It's actually a 3-part series for us. Okay, yeah, it's all about scoring the levels using the odds enhancers. Exactly, SD. Thanks for helping out in the chat there. And to some people, you're brand new at this. To other people, you've gotten some of this before. And so Harley, you don't really need to use fibs with this method. Just follow price. Yeah, the reason why I wouldn't bring fibs into this, again, I don't want to just beat everything up, but I just want to kind of sit here and be honest with you all day. You could bring, Fibonacci retracement levels into this, but think of it this way. At the end of the day, you're always going to have, 3 to 5 levels to choose from if you go the fib route, right? Your question is going to be, okay, which line do I use to buy or sell the retracement at, right? Well, the one you're going to choose, the one that's going to work, is the one that lines up with a real level, a real supply and demand level, right? So then you'll start doing that for a while, matching them up, and eventually you're going to say to yourself, well, if I'm only taking the lines to line up with the real levels, why do I need the lines? Okay. All right. Let me just make sure. Right. Okay. Let's see. Let me go on here. 1 second. And let me grab the next one. Here we go. So this next one, there's this next one is, okay, number 4. How far did price decline away from the level before returning back to the level? So here's our supply level. This is the euro, okay? Here's supply level. This is euro. Again, this is a supply level because prices fall away from this level. So they move from right here to all the way down here. So the question for this one is, what is this distance? Is this a big distance or just a small distance, right? So how far did prices move away from the area before returning back to the level up here, which is where we push the sell button for this trade? Okay, this is where I sold short with a protective buy stop just above the level in case it doesn't work. Not every trade is going to work. Make sure you understand that. So that's the whole point of market timing, to get that low-risk trade. So we sold short right here. And again, now this odds enhancer that I'm showing you here hits on 2 things, probability and profit margin, okay? On the probability side, the farther prices move away from the area before returning back to the level, that means that when I sold short here, I didn't just sell to a buyer who was buying after any old rally in price. I sold to a buyer who was buying after a huge rally in price, okay? Way up. In other words, that buyer who bought from me, they weren't buying low on the supply-demand curve. They weren't even buying near equilibrium. They were buying way up on the supply-demand curve where the odds are completely stacked against you, okay? Makes sense? And when you're, and on the profit margin side, when you're taking supply-demand levels out at the extremes of the supply-demand curve, you know, you're usually going to have big profit margins in your favor, okay? Jack's asking actually a good question. It's not, and I want you to know too, it's not like I'm picking some questions and skipping others. I look at the chart when I'm talking about the points, and then afterwards I'll glance over the chat. But I did see an interesting question about that Jack asked. Jack says, how much does it have to move away from an area, like as a rule? Okay, that's a very important question. And here's something I think you really, really, really want to do. I'll explain it slow, but here's the thing. So Jack or anybody, if you look at this chart, let's say that this supply level is, I don't know, let's call it 20 ticks or 20 pips wide, okay, from top to bottom, okay. Say this is 20 pips, 20 ticks wide. When price starts to fall away from it, make sure you hear me clearly here. When price starts to fall away from this area, this does not even become a supply level, okay. I would not even call it a supply level until prices dropped at least, until prices dropped at least 40 to 60 ticks or pips away. Does that make sense? Yeah, I wouldn't even call this a supply level unless prices moved 40 to 60 pips away. Okay, then it becomes a supply level. All right? But just because if it's a 20 pip range and then just drops 5 pips, 10 pips, I would never sell short against that. Okay? I want the chart to tell me that a significant profit margin has opened up. Does that make sense? And let me carry that a little bit further because, again, today I want to take this session farther than we've ever taken it before. Let's say you're looking for opportunities that offer you 3 to 1. Okay? And Jack, since you asked the question, what's ideal for you? Are you looking for opportunities that offer you 3 to 1, 2 to 1? What are you looking for? You tell me. Make it 5 to 1, whatever you want. 3 to 1. Okay. So here's a little trick you can do that's very important that can really help you. If you are looking for 3 to 1, okay, then I'm saying if you want 3 to 1 profits, right? If you want 3 to 1 payouts, find opportunities on the chart that are offering you at least 4 to 1. Does that make sense? And then take your profits at 3 to 1. If you want 2 to 1, make sure the chart is offering you 3 to 1. You see what I'm saying? Okay. Yeah, so Bastin, I see your last question there. So when price drops 20 pips away, kind of what does that have to do with it? Remember, we don't know this supply level here. Before prices move away, maybe they rally from this level, maybe they drop. But before they move away from this level, how do we know what the order flow is in there? We don't see the orders. How do we know what the supply-demand relationship or equation is? We only know that after prices leave the level. We want to make sure it's a strong move away from the level that goes at least 2, 3 to 1, whatever. Now, once prices move away, then we want to get back on the retracement. Because remember, the buyer who bought here doesn't realize, obviously, that they're buying into a price level where supply exceeds demand. Okay? Okay. Oh, Baston, good question there, your last one. Because the further it moves away, now that, let's say it goes down to 137, now now it has to travel 100 pips to get back to 138, right? Makes sense, right? Obviously, you have to travel 100 pips to get to 138. So now you're going to push the sell button at 138, right? But now think about the person you're selling to. Think about that buyer. They're waiting They were waiting for a 100 pip rally to buy. Wouldn't you love to sell to people that do that all the time? And they happen to be buying into a price level where supply exceeds demand. You see my point? The fact that it drops to 137 or even better, 136.50, now 138 becomes an even better level. They don't understand that they're paying ridiculous retail prices. They're not paying Walmart prices anymore. Now they're paying, Macy's or Saks Fifth Avenue or one of those. Make sense? Okay. All right, let's keep plugging away here. And let me get to here. Okay, hang on just 1 second, and then we'll go. Okay, here we go. Okay, so I just want to kind of quickly go through this little checklist here of odds enhancers. We've talked about some of these. How did prices leave the level? Okay, that helps us with probability. How much time did price spend at the level? Again, that tells us, gives us a really good clue as to the supply-demand equation. Is there a profit margin? Number 3. Okay. Now the reason number 3 there, okay, that's a deal breaker. If you don't have a significant profit margin, you don't have a trade. Okay. In other words, this is very important. Number 3, you may have the best supply and demand levels you've ever seen on a chart, but if they're too close to each other, there's no trade. Okay. Think about Walmart. People probably try to sell them stuff every day, right? Hundreds of things. But what's Walmart going to pick? They're going to pick the things that sell. But number 2, no matter how cool the product is, if it's going to cost them $5 to buy it, they can only sell it for $5.50 or even $5. It's just a great product, but they're not going to put it on their shelves, right? Okay. There has to be a profit margin there. In other words, find supply and demand levels on the chart that they're far away from each other. Okay. Ignore the opportunities when they're too close. Like I said before, if you're looking for 3-to-1 payouts, 4-to-1 payouts, 5-to-1 payouts on the chart, let's say you're looking for 5-to-1 payouts on the chart, in the trade, make sure the chart is offering you 6 or 7-to-1. Now it's going to make it that much easier to grab your 5-to-1, right? Next one, trend. We certainly want to be trading with the trend. I didn't talk about that much here yet, okay? But in an uptrend, we want to be buying pullbacks to demand levels and using supply levels as our targets. In a downtrend, we want to be selling rallies into supply levels and using demand levels as our targets. Okay? We talked about number 7. We didn't talk about number 6 yet. We'll talk about that in a little bit. Okay? And I just saw we're at the top of the hour, and I'm not supposed to go over my time here today. So, but we're going to be back in an hour, I believe. Vicki, is that right? I believe we'll be back in an hour. Okay. Yeah, and I really, really apologize if I missed some questions. But certainly just, if I didn't get to a question you really wanted answered, just highlight it and copy it and paste it in on a Word document and then paste it back in here in like an hour and we'll get to it. Okay? Yeah, we're definitely going to finish the list. We'll start out the next session finishing the list, and then we'll get into the live charts and go on from there. Hopefully this is helpful, and again, we're just getting started. So take a break, and we'll see you, I believe, in 1 hour. All right? Thanks for your time. This is all recorded, so we'll see you in about an hour.